The accounting equation is a fundamental principle in accounting. It forms the backbone of the double-entry bookkeeping system. This system ensures that every financial transaction is recorded twice, maintaining a balance in the books. The equation itself is simple, yet powerful. Assets equals liabilities plus equity. This elegant formula, credited to Luca Pacioli, a Franciscan friar during the Italian Renaissance, has stood the test of time. It serves as the foundation for understanding the financial position of any entity, from small businesses to multinational corporations. Pacioli's equation, first published in his groundbreaking work Summa de Arithmetica Geometria, Proportioni et Proportionalita in 1494, marked a turning point in accounting history. Before Pacioli, accounting practices were inconsistent and often shrouded in secrecy. His work brought clarity and standardization to the field, laying the groundwork for modern accounting principles. Pacioli's equation, despite its simplicity, captures the essence of financial accounting. It presents a snapshot of an entity's financial health at a specific point in time. By understanding the relationship between assets, liabilities, and equity, we gain valuable insights into an entity's financial strengths and weaknesses. To fully grasp the significance of Pacioli's equation, we need to dissect its components. Assets represent what an entity owns, resources that hold economic value and have the potential to generate future benefits. These can include tangible items like buildings, equipment, and inventory, as well as intangible assets like patents, copyrights, and goodwill. Liabilities, on the other hand, represent what an entity owes to others. These are obligations that arise from past events and require the entity to sacrifice economic resources in the future. Examples of liabilities include bank loans, accounts payable to suppliers, and salaries owed to employees. The final piece of the puzzle is equity, which represents the residual interest in the assets of the entity after deducting its liabilities. In simpler terms, it's the portion of the assets that belongs to the owners. Equity can be further divided into contributions from owners or capital and retained earnings, which are profits generated by the business. Understanding these three components and their relationship is crucial for interpreting financial statements and making informed business decisions. Pacioli's contribution to accounting extends far beyond the equation itself. His work popularized the double-entry bookkeeping system, a method that revolutionized financial record-keeping. This system, still widely used today, ensures accuracy and helps prevent errors in financial reporting. Pacioli's influence is evident in the widespread adoption of his equation in modern accounting software. Programs like QuickBooks and SAP, used by millions of businesses worldwide, are built upon the foundation laid by Pacioli centuries ago. His work continues to shape how we record, analyze, and interpret financial information. Despite facing accusations of plagiarism, Pacioli's impact on accounting remains undeniable. His work, translated into multiple languages and studied by generations of accountants, cemented his legacy as the father of accounting. His equation, a testament to his enduring contribution, continues to be the cornerstone of financial accounting. While Pacioli's equation provides a solid foundation for understanding financial position, the complexities of modern business transactions require a broader perspective. This is where Sony Warsono, a prominent Indonesian accounting academic, enters the picture. Warsono, known for his critical analysis of accounting standards, offers a unique perspective on the accounting equation. Warsono argues that the conventional expanded accounting equation, which includes revenues and expenses, places undue emphasis on the right side of the equation. He proposes an alternative formulation: assets plus expenses equals liabilities plus equity plus revenues, which he calls the law of funds. This alternative equation, according to Warsono, provides a more accurate representation of the flow of funds within an entity. It emphasizes that the total uses of funds, represented by assets and expenses, must always equal the total sources of funds, represented by liabilities, equity, and revenues. Section 5. The logic behind Warsono's approach. Warsono's approach stems from his belief that accounting should reflect the economic reality of business transactions. He argues that the conventional expanded equation, by placing expenses on the right side, creates a disconnect between the use of funds, expenses, and their sources, liabilities, equity, and revenues. His law of funds equation, on the other hand, aligns the equation with the fundamental accounting principle of duality. This principle states that every transaction has two aspects, a debit and a credit, and these aspects must always be equal. By placing expenses on the left side alongside assets, Warsono's equation highlights the fact that expenses are essentially uses of funds, just like the acquisition of assets. This approach, he argues, provides a clearer and more logical representation of the flow of funds within an entity. Section 6, a new dimension, Ismuhadi's tax-focused equation. Adding another layer to the evolution of the accounting equation is Joko Ismuhadi Suwarsono, an Indonesian tax expert. Recognizing the growing importance of taxation in the 21st century, Ismuhadi introduces the concept of a tax accounting equation. This specialized equation aims to integrate tax considerations into the traditional accounting framework. While the exact formulation of Ismuhadi's equation remains under wraps, it likely incorporates elements like tax liabilities, tax expenses, and deferred tax assets. The primary objective of this equation is to provide a tool for tax authorities and businesses alike to better understand and manage tax obligations. Ismuhadi's equation goes beyond simply calculating tax liabilities. It aims to detect potential tax avoidance and evasion by analyzing discrepancies between reported income and tax obligations. By incorporating tax-specific variables, the equation provides a more comprehensive view of an entity's financial performance from a tax perspective. Section 7. Ismuhadi's equation in action. A practical example. Imagine a company that reports a significant increase in profits but a simultaneous decrease in its tax liabilities. This discrepancy might raise red flags for tax authorities. Using Ismuhadi's equation, they can delve deeper into the company's financial records, examining factors like deferred tax assets and tax expenses. If the analysis reveals aggressive tax planning strategies or questionable accounting practices, the tax authorities can investigate further, potentially uncovering tax avoidance schemes. This proactive approach, facilitated by Ismuhadi's equation, allows for more efficient tax audits and helps ensure compliance with tax laws. Ismuhadi's equation represents a significant step towards integrating tax considerations into mainstream accounting. By bridging the gap between financial reporting and tax compliance, his work has the potential to revolutionize how businesses approach tax planning and reporting. Section 8. Comparing the giants, Pacioli, Warsono, and Ismuhadi. While Pacioli, Warsono, and Ismuhadi offer distinct perspectives on the accounting equation, their contributions are interconnected. Pacioli's basic equation provides the foundation, while Warsono and Ismuhadi build upon it, addressing the evolving complexities of the accounting world. Pacioli's equation focuses on presenting a static snapshot of an entity's financial position at a specific point in time. Warsono's approach, on the other hand, emphasizes the dynamic flow of funds within an entity, highlighting the relationship between the uses and sources of funds. Ismuhadi's equation adds another dimension to the analysis by incorporating tax considerations. It goes beyond traditional financial reporting, providing a tool for tax optimization, compliance, and fraud detection. Each iteration of the equation reflects the changing economic landscape and the growing need for more sophisticated accounting tools. Section 9. The equation's journey, a testament to adaptability. The evolution of the accounting equation from Pacioli's foundational formula to Ismuhadi's specialized tool highlights the adaptability of this fundamental accounting principle. As business transactions become increasingly complex and new challenges emerge, the accounting equation continues to evolve, providing a framework for understanding and navigating the intricacies of the financial world. The journey of the accounting equation is a testament to the dynamic nature of accounting itself. It underscores the importance of continuous learning, critical analysis, and innovation in the field. As we move further into the 21st century, one can only wonder what new dimensions will be added to this timeless equation. The accounting equation, in its various forms, remains an indispensable tool for anyone seeking to understand the financial health and performance of an entity. Whether you are a student, a business owner, or a seasoned investor, a firm grasp of this fundamental principle is essential for navigating the complexities of the financial world.